Hello everyone, this is Sebastian McMahon from IA Financial Group and I'm back with the weekly review, this time for the week ending June 7th, 2024. So an eventful week in the country. We had the first cut from the Bank of Canada. We think is the first of likely four this year. So the train has left the station. That's the good news. We had an employment report this morning in the country suggesting that the labor market is not that strong. So the headline was positive, but when you look under the hood, you see that it was mostly part-time, mostly the services sector, the goods sector was negative. Once again, we're not creating enough jobs for population growth, so we're still in this story here. So likely we will have another cut by the Bank of Canada on July 24th. At least this is what we think. We'll have two more CPI reports until then. We'll have one more jobs report until then. So if the trends continue as they're going right now, all odds are that we'll have another cut in July. So we think it's going to be four cuts this year, likely four in 2025, and maybe an adjustment early 2026 to bring us back to neutral, which is about at 2.75% by early 26. So we'll discuss that in a minute. Before we go into that, maybe if we look at the markets at the week, the close at the this week's markets at the close on Thursday. All right, so positive for bonds with the rate cut in the country and the messaging from the Bank of Canada that there's going to be more cuts coming. I mean, they actually said that in the opening statements from Tiff Macklem that if the trends continue, we should expect more cuts. So it was very clear. So rates down, good returns for fixed income. And if you look at the TMX universe, we're back in black. So good news there. Equities negative into the other TSX, but very much positive everywhere in the world. So good week. Oil down, Canadian dollar down. Price of gold up 2.1% after 4 days. As I'm recording this though on the Friday morning, price is down about 1%. So some volatility, but we're ending the week in a positive levels. So good news there for the price of gold. Going into the details of the rate cut here. So the chart here, as it shows, this is the first cut in 4 years from the Bank of Canada. But when you look at this chart here, it can be misleading a little bit because there are some expectations that the rate cuts should be swift and quick, but we're not living in this kind of world anymore. So if you look at the 2008, 2009 rate cuts, of course, we had a financial crisis and everyone was cutting at the same time very quickly. So the easing of monetary policy was swift then. After that, some adjustment higher between 2018 2020, then the pandemic, so everyone cuts at once. And after that, we need to make sure that the COVID situation is enough under control to start fighting the inflation, which was already running wild at the time. So rate hikes were very quick, very swift. But now we're not in the crisis situation anymore. So now we're looking more at the moderate, at the sustained pace of cuts, which will take some time. So this is the message. We're looking at 4 cuts this year, probably 4 cuts in 2025, and then after that 1 or 2 in early 2026, and this will bring us to neutral. So that means that we won't have a break on the foot on the brakes of the economy. So the foot is going to be lifted slowly until it's not on any pedals. So we're not hitting the gas, not hitting the brakes when we're at neutral. Likely that's going to be somewhere in early 2026. So this is the base case scenario that we have as of now. Of course, many things can happen to push the Bank of Canada to slow down the cutting rate or to accelerate. So we'll see how things happen. But if the trends that we're seeing now continue, so the Canadian economy is rather weak, but it seems to be accumulating positive surprises recently. So good news there. Inflation is steadily going towards 2%. So again, a moderate pace from the Bank of Canada makes a ton of sense. But they did flag two risk factors. So if we go with the first one, housing. So there's 2 charts here. On the left, you see evolution of housing prices in the main cities in the country. Strong pace of growth during the pandemic, of course, changing of habits, lower interest rates. That was the initial impulse. But since then, demographic growth has been very strong. So even though we've had high rates, demography has been pushing housing prices higher. If you look at just the recent activity in prices, you see that prices have been picking up recently. And this is no stranger to the chart on the right, where you see that mortgage rates have started to fall recently in expectation of the rate cuts that have started now. So when market starts to expect rate cuts in the future, then of course the yield curve will adjust, and here's the 5-year rate, the market rate, which has a strong incidence on the mortgage rates, started to fall already, and we've seen housing prices bounce again. But that's at the same time where demographic growth is accelerating. So it's hard to separate one factor from another. So it's a risk factor. The Bank of Canada have been pretty clear, and we think that they're right, to want to separate housing from the rest. Monetary policy, the interest rate is a very blunt tool. You don't want to push the economy into a recession because you want to keep housing under control. You have to balance the two. The signals from the economy are pretty clear. It's time to start cutting. But if there's one thing that could keep the Bank of Canada from going at the pace that we think that they should be going, maybe it's going to be housing, or at least expect them to address housing very regularly starting from now, to make sure that you're not creating some issues in this market here, while it's doing the right thing for the rest of the economy. So risk factor number one. The second one that they mentioned again is wages. Why wages? Well, wages this morning actually they reaccelerated in the country, so they were right to mention it, 5% year over year. But the chart on the right is the key here. Canada is more of a services economy now, and inflation in services is tightly linked to inflation in wages. So inflation in wages leads to inflation in services, which leads to sticky inflation. And as long as wages remain hot, there's going to be some risks that inflation in services is going to be sticky. And if by cutting interest rates too quickly, they start to fuel the economy, they start to fuel wage pressures again, well, that could lead to some inflationary pressures again. So again, this is a second risk factor that they will be following very closely. So these two things, housing and wages, will be focusing on that throughout this easing cycle. Now, what about the loonie? So we wrote about that in the May 2024 edition of the Monthly Macro and Strategy. The link here is at the bottom of the slide. Two charts from this publication. So the Canadian dollar, now we're at 73 cents. We are lower than we were in 2021 and early 2022 because the Canadian economy has been weak compared to the US economy over that period. So there is already some of that in the price. The table on the right, this is a model that we ran, that we explain in the monthly. Now we're at 73 cents. Here, just quickly, because you can go to the note to get the details, but we believe that if we see 4 cuts this year in Canada and 0 in the US, so if the gap between the two central banks widens by 100 basis points, that leads the Canadian dollar to depreciate, but to somewhere around 70 cents. We're not talking about 60 or 65 cents. It's about 3 cents lower, which is about an impact of 5%. There are other factors at play, so there's not just monetary policy that's influencing currencies. You have economic surprises, the differential between the two countries. You have the price of commodities for the Canadian dollar, for example. So there's many factors, and in fact there might be some factors that could be pushing the Canadian dollar higher throughout this period. So if you give a breath of fresh air to the Canadian economy and it starts to surprise but positively on the economic sense, at the same time as in the US we've seen an overheating recently and the surprises are starting to come out as more negative, maybe that could even be a positive force on the Canadian dollar. So we think the path of least resistance is lower. 70 cents looks reasonable to us, but we're open to actually believing that the drawdown could be a bit less than that. So we're not in the camp that the Canadian dollar is going down to 60, 65 cents we're not thinking that at all. So what we'll be watching next week, Canadian and the Canadian front will have building permits. Should be a good month in April. In the US, light in the quantity but important in the quality of indicators. CPI inflation month over month should be friendly. Year over year, not so much. So likely we won't get new signals there. But we'll have a very important Fed rate decision. No one is expecting a Fed cut next week, and in fact the market has a reaction on the employment report that we've had this morning, which was actually pretty solid, has now pushed out the first rate cut all the way to December, which is actually pretty much in line with the view that we've had since the beginning of the year. So we think that this makes sense. So 0 cuts by the end of the year, maybe one that's squeezed in December. The market is pricing that in right now, but next week don't expect a rate cut. So that wraps it up for the week. If you want to, if you appreciate the content here, please share, and of course come back again next week.